Let's get in a view from Jonathan Garner, Chief Asian and EM Strategist at Morgan Stanley. He joins us live from Hong Kong. Jonathan, thanks so much for joining in. First, before we talk about how this would impact the emerging markets, did the decision surprise you? And more so, the commentary about the interest rates, is that a net positive?
Well, it didn't actually surprise our Indian economist, Kanhaiya. He was actually expecting the RBI to wait and to review incoming food inflation data. In terms of the RBI's own rate policy decision going forward, we do still think interest rates are likely to head up. If you're referring to the Fed's decision on tapering, again, consensus expected it more in March. However, we were of the view that it could happen earlier. I wasn't really clear what question you were asking about as I joined your show relatively recently.
Fed decision and the commentary on the interest rates, wherein Ben Bernanke did say that well past the unemployment levels crossing the 6.5 mark, the rates would hold at the current levels.
Okay, so if you're asking about the Fed, I think what was interesting is that the commitment was retained to looking at the 6.5% unemployment rate and increased emphasis really on the undershoot on inflation. And so what the Fed's trying to do is deal with what's been called the separation principle, i.e. separate Fed tapering from actual tightening. And the equity market reaction in the US was very positive overnight. I think that we'll get a muted rally in Asia ex-Japan, but the prime beneficiary is going to be Japan on further yen weakness.
What's the market outlook now then, Jonathan, when it comes to US in particular? Where do you see the dollar headed now that the news is out?
Well, we think the dollar, and this has been our view for some time, remains globally strong and strengthens particularly against emerging countries that have significant external imbalances. So, for example, in India's case, the Indian rupee is likely to remain in a medium to long-term downward trend against the US dollar. Until the current account deficit has further narrowed significantly. We're also concerned about the currency outlook in countries like Brazil, South Africa, Turkey and Indonesia. The financial market reaction is very similar today to what we've seen all year, which is that the US and Japan equity markets are the prime beneficiary of what's an undergoing endogenous recovery in the US economy.
Jonathan, you mentioned that the reaction in the Asian markets would be muted. I was looking at a few brokerage reports and all of them said that the decisions taken yesterday or announced yesterday are very constructive for emerging markets in general.
What decisions are you referring to?
The fact that the tapering may be $10 billion, but that the interest rates would be held at the levels, at the current levels until the unemployment rate crosses 6.5 mark.
Yeah, but it's more positive for Japan because Japan's a beneficiary of dollar strength and yen weakness, and it's more positive for the US itself because this is all happening. The Fed's comfortable in making this change because the US economy is improving. The economic growth environment in the emerging world is still very subdued, with the notable exception of China and parts of North Asia. So in South Asia, we've had slowing growth rates, particularly in India, and very low growth rates to history in Brazil, Russia, South Africa. So there's nothing new here that would change the outlook of being quite cautious on EM and Asia, excluding Japan.
Jonathan, do you see a readjustment of fund flows across emerging markets at this juncture?
If your question means are we expecting some markets to benefit more than others, yes, definitely we do. We expect North Asia, so Hong Kong, China, Korea, Taiwan, to materially outperform South Asia. That turning point happened at the start of this year, and it's accelerated as we've moved into this Fed tapering situation, and the concerns about funding external deficits in the more vulnerable countries have appeared. We also have elections on the calendar in most of those countries that I mentioned earlier for next year, and whilst that offers an opportunity for fundamental reform longer term, it probably keeps equity flows quite muted towards these countries, whereas we're past the point of political change in terms of the incoming government in China, and also we had elections recently in Korea and before that in Taiwan. So North Asia is likely to continue to attract higher fund inflows.
Jonathan, I know you answered about the fund flows, but what I want to ask you is that when the tapering decision, the first rumblings of tapering came about in May, markets like India saw quite a bit of outflow. Do you think that will be more tapered or more relaxed this time around?
Well, I think if you look at fixed income, it was a very significant watershed in May because the prior 2.5 years there have been persistent, strong fixed income fund inflows to the emerging world, including India, and that's now reversed structurally. And so we don't have to go through that significant turning point on fixed income flows. On equity flows, they've been more volatile throughout the last 3 years, but we are recording 7 out of 10 weeks outflows from EM equity funds right now. And that's, again, very interesting at this time of year. One would normally get fund inflows. So it suggests that any allocation process at year end is heavily skewed to the US, Japan, and developed equities more generally, and not to emerging markets.
So, Jonathan, finally, what's the India view now that the Fed's decision is out? We've seen what the RBI did yesterday. And, of course, we've got a big trigger or a big question mark by way of general elections next year.
Yes, well, if food inflation doesn't fall in India, as I was referring to earlier on, then I think there's still likely upward pressure on interest rates in India. We still have very rapid government spending growth, and we still have a CPI inflation rate that's been above the policy rate structurally. So there have been structurally negative real interest rates. So arguably there's an adjustment process that still needs to happen there. And that reflects our overall quite subdued outlook for the Indian equity market. We expect the market to be flat, if not slightly down, over the next 12 months from here. The election calendar may offer some opportunities, but it's far too soon to really be precise about that in relation to outcome or any sort of policy developments post the election. So India remains one of our less preferred markets in an Asia ex-Japan and EM context.